So I'm going to share my screen and then I'm going to kick it off. And I hope that I raise some challenges and some questions. So feel free at any time during the presentation to to either send a message in the chat, and I will try to answer that when we get to Q&A, or just turn on your microphone and say, hey, what about this or that? So here we go. I'm going to share my screen, and the title of today's presentation is Why the Fed Will Fail at QT Again. Now, you may think that I'm crazy to say this because the Fed is the most powerful organization possibly in America, and about, the quantitative easing, quantitative tightening. They've said they're doing quantitative tightening. And so now it's a question of whether we believe that they will. And the question is, will the recording be emailed to us after the presentation? That's a good question. I think Alex will answer how we can do that after the presentation. He'll probably send something into the chat to answer that. All right, so let's start off by seeing that there hasn't been much QT in the US. These three lines show us the Fed, ECB, and also the Bank of Japan. And I'm going to just go through this a little bit. And what we can see is that the Fed's QT was tiny. And now you see a little tick up right there. So there was almost no QT so far. There's been little change in the US Fed's balance sheet. Now, what I've done here is I've gone back to January of 2020, just in the year of obviously of COVID, and I've rebased the balance sheet of all of the central banks to 100, and that's how I got this chart, just to try to put it in perspective. And then what I'm doing is, next I'm going to look at how ECB has dropped recently. So we do see some fall in quantitative tightening in ECB, and Bank of Japan's balance sheet actually has grown from a little bit of tightening and now is coming back. So let's review the situation. A May Fed hike is priced in right now. This is the probabilities for the Fed meeting on the 3rd of May 2023, coming from the CME Fed Watch tool. And the market is pricing in a 58% probability of another 0.25 hike at the next FMOC meeting, which is May 3rd. So let's look at the history of this particular hike. It's the fastest and most aggressive rate hike cycle by the Fed since the 80s. It's incredible how fast. And it's part of the reason why I always say that the Fed is going to break something. After the 0.25% hike on the 1st of February 2023 this year, the current rate hike cycle became the most aggressive since the 1980s. And Fed hiked another 0.25 in March 2023. So now this is the probability weighted Fed target rate. And again, this is coming from the CME Fed Watch tool. And what we can see is the expected rate curve has shifted down significantly. And the recent events in the US bank sector, mainly Silicon Valley Bank and the other issues that are going on, have led to a shift in expectations. All of a sudden, people think the peak is now expected to be 5% in June versus 5.5 in July. Again, this is a consensus tool. And the market thinks the Fed will pivot rather than keep the rate high for some time. So previously, people had even expected that the Fed would have kept rates high for a while. But in fact, we see now a massive reduction here, almost a 1% reduction by July in expectations, July of 2024. This tells us that the market is expecting recession and the Fed to pivot. So after a 5% rate hike, the market expects the target rate to peak in June of 2023. Now, I'm just going to stop sharing my screen for a second just to talk to you directly. And basically what you're going to hear from me, and I think the market is somewhat expecting this, is that by the mid of this year, the US is going to be in recession. That is the prediction that I have of what I'm expecting. And that's going to be a challenge, and it's going to cause a lot of trouble. And I think eventually the Fed's going to have to pivot. And I'll talk more about that, but that is just to make it clear what my expectations are as far as the Fed is concerned. So we can see where things are at here on this chart. Now, considering the weighted probabilities, the peak rate is now expected in June of 2023. Previously, the expected peak was in September of 2023. So the market has moved to expect an earlier Fed pivot as a result of what they've seen in the banking industry. Now, I just wanted to, I went online to find Cam Harvey's paper that he wrote in 1986. This was his dissertation for his PhD. And Cam Harvey is the guy that came up with the inverted yield curve and how an inverted yield curve has consistently predicted every recession that the US has had over many, many years. And when we talk about inverted yield curve, what we're talking about is short-term rates are being pushed up by the Fed, and long-term rates kind of stay where they are, and so we get an inversion. And so inversion is a very, very good predictor. Now, Cam Harvey himself has even come out and said he's not sure if inversion is really going to work this time. And he had some different arguments for that. One of them is that people expect a recession, and therefore what's happening is they've been downgrading their expectations for a long time, and they've seen an inverted yield curve for a long time, and so they're adjusting, and therefore it's not going to be as big. So now let's look at how the Fed has kept the peak rate, target rate for 6 months on average since 1980. Fed is trying to increase interest rates, but every time they do, they can't leave it there for too long. Here we can see during the dot-com bust, the Fed kept the peak rate for 8 months, and during the global financial crisis, that was a record at 15 months, and then they had to reverse and reverse fast. Think about every reversal that they've done. This is the 2008 crisis, boom, down, fast, down, fast. Here you got COVID down extremely fast. And what do we see right now? The market expects the Fed to keep the peak rate for only 2 months this time. In other words, the market is expecting a very fast reversal. And I would say that it's probably going to be even faster than what people think, and it's going to come back down close to zero is my prediction. Now, the Bank of England is expected to be on par with the Fed by fourth quarter of 2023. And the expected lower rates in the EU and Japan lead us to expect a weak euro and yen against the US dollar. However, I can say that as the interest rate differential should tighten between the US and EU, the euro could strengthen against the dollar. I just wanted to highlight, if you like this presentation, you should consider joining our Become a Better Investor community, where I go through this and a lot of other stuff. I'll have more about that later. But now, ladies and gentlemen, it is the history of QE. Everything you need to know about QE and why we're going to have no QT. So here I made this chart to try to illustrate that we've had 4 QEs where the central bank bought assets. The Fed assets in this case is the black line, and then the QE is the period of time when they expand. And so one of the key things that we want to see on this is that QE starts when the Fed expands its balance sheet. When it expands its balance sheet, and when it expands its balance sheet, and when it, well, this one is huge, when it expands its balance sheet. And now, here we have the first month of QE infinity. So let's review. QE number 1 was started in September of 2008. The Fed started buying agency mortgage-backed securities, bank debt, and US Treasuries. And Fed assets went from about $1 trillion in August of 2008 to $2 trillion, so doubling by August of 2009. It's a 113% increase. Since it came from a low base, the first QE showed massive growth in Fed assets. In fact, I made this chart to try to explain it. First of all, we had the gray area, which is the Fed QE1 period of time, which we can see right here. Second, I brought in the bank deposits, which is the blue line, and I brought in bank assets, which is the green line. And then, of course, the red line is the Fed asset growth. So let's say about 110 to 130% growth that we can see in Fed assets right there. That's a pretty massive amount of QE in QE1. Now, let's now take that same chart, and instead of having, in the prior chart, remember we have Fed assets here, I'm going to change that to be CPI, and that's the black line here. We can see US bank deposits and assets fell despite massive QE. Remember that the purpose of QE ultimately is to stimulate. If QE is working well, and also remember, why is it that they're doing QE? They're doing QE because they got interest rates down at zero. When you have interest rates down at zero, you have no tools left. And therefore, the only thing you can do is try to inject money into the system. Think about it this way. When the banks are scared like they were in 2008, they're not lending. So it doesn't matter how much money or how low the interest rates are, they're not going to be borrowing at low interest rates and lending that on. And so the end result is that the banks just sit there and do nothing. So the Fed basically went out and bought the assets off the balance sheet of the banks and replaced those assets with cash in hopes that the banks would go lend. But in 2008, they did not lend. And that's what we're going to see in this particular chart. In fact, what you're going to see is that the bank assets, the commercial bank assets, fell and bank deposits fell. Now remember, the whole purpose of QE is to support the economy. And here we can see that the CPI fell. So you can have a CPI falling during QE, even though QE is inflationary, because first of all, you have a lag, but second of all, if you have a collapsing economy, then CPI may not go up. So this is an important point to understand, that QE does not always stimulate CPI. And that's why some people are thinking that the Fed won't bring down interest rates because they're afraid that inflation is going to come back. But what we can see is that if the economy starts falling, then the Fed may not worry so much about inflation. So now let's go into QE2, which started in November of 2010. The Fed bought US Treasury bonds, and Fed assets went from 2.3 in October 2010 to 2.9 by June of 2011. It's a 26% increase. So now this is fascinating. What you can see here is that QE2 was tiny. The amount of expansion in the Fed assets was about 25, 26%. There was small and steady impact on bank assets and deposits. However, let's look at this in more detail. So I'm going to replace the Fed assets with the CPI. And here is what we see. What we see is that QE2 accelerated deposit and asset growth at banks, and it also accelerated the CPI. And therefore, we can see that QE2 was an inflationary QE because the reaction of the banking system led to a CPI increase. So now let's look at QE3, which started in September of 2012. This is the first time that people started to call it QE infinity. In September of 2012, Fed assets were at $2.8 trillion. And by June, just 9 months into QE3, Fed Chair Bernanke tried to talk the market off of QE. He wanted to stop. But the market didn't like this, and it crashed. On October 2014, it was the final month of QE3. 16 months after the Fed had hoped to end it. They lost control. And this is part of the reason why people said it's QE infinity. They can't reverse it. And in this presentation at the end, I'm going to show you why I don't think that anybody on this call would think that the Fed can do quantitative tightening ever, not just this time, but ever. And I'll show you a chart that I think will convince you of that. Now, at that time, Fed assets were up about 60% to US 4.5 trillion, mainly consisting of mortgage-backed securities. Now, it is important to think about this for a moment about, what is QE? Basically, what's happening with QE is that the banks have basically, let's say, loans. Let's keep it really simple. Banks give out loans. They're not liquid. So if depositors said they wanted their money back and the bank only had loans, it wouldn't be able to liquefy those loans and pay back their depositors. And so the banks have regulations that require them to hold a certain amount of cash. Now, sometimes they also own government securities, not so much corporate securities, but let's say government securities, because the big banks are the primary dealers, so they're buying all the securities off of the Treasury Department. And then the bank has to make a decision: do we continue to hold these treasuries, or do we sell them to our clients, to other banks, or do we sell them to the Fed? What happens when QE goes on, and there's a third one. So I said loans, mainly I'm talking about business loans, and then I talked about government securities, and then there's cash. But the other item is mortgages, and basically banks give out mortgages to consumers to buy houses. And what's critical in America that doesn't exist in most countries, it definitely doesn't exist here in Asia, is US has a secondary market for mortgages. That means that if a bank decided that it wanted to get rid of the mortgage loans that it has on its balance sheet, it can sell those mortgage loans to Fannie Mae and Freddie Mac, which are quasi-government, you could say government institutions. And Fannie Mae and Freddie Mac will buy those mortgage loans and hold them. Now, sometimes Fannie Mae and Freddie Mac get filled up, and that's when the Fed comes in and says, we'll buy those mortgages. Now, the Fed basically first thing is they just want to buy US Treasuries. The Fed is not allowed to buy treasuries directly from the government, from the Treasury Department. Those treasuries have to be sold to the primary dealer banks. And then the primary dealer banks then basically, if the primary dealer banks want to offload them and the Fed is buying, then the Fed can buy all the treasuries. This is partially what happened when foreign investors stopped investing in the US Treasuries. So particularly China, but other countries stopped buying US Treasuries. And what happened was that all of a sudden, that meant that the Treasury didn't have any buyers for Treasury bonds when they're running all these deficits. In order for the Treasury to attract foreign investors back, they would have to increase interest rates pretty substantially for people to say it's worth it to put my money in the US Treasury. And they didn't want to do that because of the damage that would cause. So what did they do? They got the Fed to buy all those treasuries. And so my point that I'm making here is that treasuries are the first thing that the Fed buys. And that's what we've seen in this new program that the Fed came up with after the Silicon Valley Bank situation, where the Fed said, hey, you got treasuries, sell them to us, we'll hold them, and then we'll give them back to you at the end of the year. And we, meaning the Fed, will hold the losses. Now, part of my prediction is that in the next, I would say in the next three months, my prediction is that we're going to see, I'm going to sit down, by the way. My prediction is that we're going to see the Fed start to buy mortgage-backed securities, MBS. And why is that? Because I think that the regional banks are going to be under a lot of pressure, as they are right now, and they may not have a ton of treasuries. And the result is they have a lot of mortgage loans. They're going to sell them to Fannie Mae and Freddie Mac to get cash for those. And then I suspect that the Fed will announce at some point that they're buying these mortgage-backed securities from Fannie Mae and Freddie Mac. And that basically brings those mortgages out of the system and brings the money into the system. So let's go back to mortgage-backed securities, which we were just talking about. And here you can see what I was saying about what's happening, mainly mortgage-backed securities. That's why I stopped to talk about that. And the Fed informed the market for QE3 that it would keep the Fed funds rate at 0. And that was kind of their deal, to keep the market from crashing by telling them, don't worry, interest rates are going to be at 0 for a long time. So QE3 was bigger than QE2, but had minimal impact on bank assets and deposits. We can see that QE3 was about 40% growth in Fed assets. So now let's replace Fed assets with CPI. And here we can see QE3 bank deposit growth actually fell. And we can see that there was almost a doubling in asset growth to 10%. So we can see that deposits fell and asset growth rose. And in addition, we can see that CPI fell. Well, why was CPI falling that time? So we've seen CPI falling here, CPI rising here, and CPI falling here. Well, it was peak time for low-cost Chinese imports, and oil prices was down and was low at that time. So now let's look at QE4. This is March of 2020. Now, I'm going to tell you that this presentation is not that long. So if you've got questions, make sure you put them into the chat, and hopefully we'll have a discussion at the end. And feel free to challenge what I'm saying. I'm happy to discuss and debate to think about it. So Fed assets were 4.2 trillion in February of 2020. By the end of May 2020, they were 7.1 trillion. A second wave of increases came from December 2020 to November 2021, when Fed assets peaked at 8.94 trillion in April. That's up 112% for QE4. And here we can see that QE4 saw 90% growth, roughly, let's say, to 100. It's a little bit different on my chart, but let's say about 80 to 90% growth. But remember that it was starting with a base of 4 trillion, whereas QE1 was starting at less than 1 trillion. And that's the reason why we had such a huge amount. But as the balance sheet of the Fed kept growing, we can see that it gets harder to have strong growth. But I don't think, this is just a massive amount of money printing and spending. So let's now replace the Fed assets with the CPI and see what happened. Because in theory, when we have a very high level of growth in Fed assets, we should see that CPI rose. But we didn't see it here because we were going into a recession. So let's see what we found here. So QE saw bank deposits explode and assets too. So we can see bank deposits were massive. And eventually, with a lag effect, CPI started to rise. CPI didn't move initially, but eventually took off, especially because of the trade war with China, COVID supply chain disruptions, reduced supply of goods and services as most people didn't go to work, and oil price was spiking at the time. Now, once we had a huge peak in the growth in assets and deposits, then we started to see that come down. Now, before I go further, I want to talk a little bit about this massive increase in deposits in the commercial banks that was caused by QE4. QE4 was a serious QE. Basically, the Fed and the US Treasury just pumped a huge amount of money into the economy. And in fact, they kind of went around the banks. What they did is they basically printed money and put that money into the deposit accounts of businesses and individuals. So here you have banks that all of a sudden had a massive increase in deposits over that time. Some banks saw doubling, tripling of their deposits, like Silicon Valley Bank as an example. Well, that's a huge increase in deposits that was happening across the whole US banking sector. So what happened then? Well, it also was a bit of a scary time. I think nobody was really sure what the recovery would look like and all that. And so as a result, these banks were hesitant to lend. So if you look at the loan growth numbers of the US banks from 2020 to 2022, they weren't that high. The banks weren't lending. And so the deposits that were coming in the bank had to be taken care of. So what did they do? They bought US Treasuries. Well, US Treasuries were trading at about 1 to 1.3% for, let's say, 1 year Treasuries or so at the time. And the fact is that they just sat on those thinking, okay, there's nothing else to do. And also, there's a calculation of risk-weighted assets when we look at banks. And the Fed and the Treasury Department basically had told the banks in the past, after 2008 and maybe after 2012, that they didn't have to set aside any capital for government bonds because they're risk-free. And you may say, Andrew, I thought government bonds are risk-free. Why are we hearing that government bonds are losing value? Well, they're credit risk-free because you're exposed to the credit of the U.S. government, but they're not interest rate risk-free. They can go up and down depending on what's happening with interest rates. All right, so let's go back. So my point is that all of the banks had to deal with a massive amount of deposits coming in. This didn't happen in places like Thailand because the government didn't print a lot of money and put it into the bank accounts of the people. It didn't happen in places like Europe also because the way Europe handled it was that Europe tried to encourage all the companies to stay open and keep all the employees in place. And then the government would basically subsidize and pay the companies so that they would keep people employed. They could use that money for the salary. But in America, they basically just let everything shut down, and then they pump money into the deposits of individuals and businesses. And that's why we have such a huge increase in deposits here. And then eventually the fall is just a year-on-year calculation. It's hard to maintain at that point. So now let's look at QE5. We're getting to the end of today's presentation. QE5 started in March of 2023. Now, this is me saying QE5. I don't think anybody out there has now named it QE5 yet, or maybe they have, but I'm saying now is the time. It's here. The Fed had attempted tapering in May of 2022 and managed to bring its assets from 8.9 to 8.4 by February of 2023. But the failure of Silicon Valley Bank and Signature Bank kicked off QE5, with Fed assets expanding by $324 billion in March of 2023. This brought Fed assets to $8.6 trillion, its first expansion since April of 2022. This 3.1% month-on-month increase was the fastest increase since May of 2022. So let's look at it. What do we see? Welcome to the first month of QE5. It starts off small. You can see the red line there. Fed assets rose by about $300 billion in 1 week. And you may say, Andrew, come on, that's not QE5. That's just a little move. Well, I'm going to show you why I think it is. First, let's look at the situation. Again, I'm going to replace the Fed assets in this chart with CPI. So what do we see? QE5 has not produced enough info yet, but bank assets will likely rise. And I expect continued fall in CPI. And if QE5 really takes off, the impact on rising CPI could be a long way away. I think we've got probably, my forecast is we're going to get to 4% by this year end. This is because of owner's equivalent rent basically taking a long time to come down, but it's very steady down, I think, from here. And if we get an impact of QE5, I would say that it's going to come later in maybe 12 months. So that's why I say that I don't think the Fed, and if the economy crashes, then it isn't going to be CPI bouncing. It's going to be CPI remaining low. So here's the chart that I wanted to show you. We've seen 4 big QEs and 4 feeble attempts at QT. And this is the reason why I want you to understand why I say QE infinity. Let's look at this for a moment. This part here is when the government, the Fed, announced quantitative tightening. And how much quantitative tightening did they do? A tiny little bit. And then the Fed announced quantitative tightening again. And how much tightening did they do? A tiny amount of tightening. And then the Fed announced they're going to do quantitative tightening, and they did no quantitative tightening until eventually they had a little bit of quantitative tightening, and then boom, 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 all of a sudden we're back at it. And then they're going to do quantitative tightening, and then boom. My point is that the Fed has never been successful with quantitative tightening. So why is this important? It's important because this helps us to understand that when the Fed is talking about quantitative tightening, it's bullshit. I don't believe it. I don't believe it's going to happen because it's never happened before. It's too much tightening, and everybody's used to a very low interest rate. So now, if you've got questions, just type them in the chat. I'm going to get to them in a second. So I just want to reiterate, there's a lot of summary stuff I won't go through here, but the key thing is that the Fed has failed at QE again. And it's time to feed the money addict, is what I like to say. It's like Americans are addicted to QE. Now, just before I wrap up, if you want to get more of this kind of stuff, join us in the Become a Better Investor community. And because you're on this call, you can join for free to start off. Now, you'll get access to our membership platform, and you'll get research like this research. We regularly publish unbiased and partially unconventional research theme. And from quick takes on data and deep dives to forecasts, our members benefit from actionable reports. And you'll stay on top of the markets with our cheat sheets and be well informed when you'll use our FEMR cheat sheet and snapshot. Also, we have strategies. These are stock strategies and asset allocation strategies, and we provide them. They're ready to invest strategies that you can execute as is, or you can get inspiration from them. So you can literally copycat what we're doing. Currently, we have the following stock strategies. That's global stocks, Asia stocks, ASEAN stocks, China A-shares, and Thailand. And then you'll receive regular updates. As soon as we make a change in any of our portfolios, we immediately tell our members. And here you can see some example of our asset class strategies that you'll see, and then what it looks like when we shift our portfolio. You get this type of information. Also, you connect with global investors striving to become better every day. You'll join the community, and the community is live sessions. We have bi-weekly live sessions to present. A lot of times what I'm doing is presenting research I have. Other people are sharing the research that they're doing, and we're talking about latest trends. And then our community chat ensures that you don't miss important news. Here's our discussion. I was developing some research a while ago, and I shared some stuff as I was going through it. And then also, oh, this one is cool. This one is cool. And I would say you should join just for this. I basically, as an analyst, I looked at every book on Amazon on business. And I tried to identify what were the top 100 companies, top 100 books on business. And that's sales, that's marketing, whatever. And from that, I broke it down into those different parts: management, sales, strategy, and all that. And then I created a list of, let's say, 3 to 5 books that are the best in each area. And then I wrote a short course on each book. And I also wrote cheat sheets and other things to help you to read that book without reading it. The short courses are about 30 minutes, and you get cheat sheets that give you everything you need to know to remember. I've been rolling this out in the group, and I'll be accelerating that rollout over the next month or so. But you can join and then get access to those and start studying those and improving from those. And those books, by the way, are all the books that are here on this shelf. Those are all the ones that I'm doing today. In fact, I just finished Fanatical Prospecting. It's a sales book. It's a great book. So we have many topics from sales to other things. So that is what I call the curriculum. And that's what I'm talking about here, the curriculum. You can see you get access to those courses. Also, you get our Business DNA interviews when I go out and interview business leaders. And our objective is really never stop learning and keep learning. I'm almost 60 and I keep learning every day. And so you also get access to some of our courses that are free or at a massive discount. The content will grow as the community grows, and we're constantly trying to add more content over time to further increase the value you get. So here's the proposal. Join us for a free trial, just 1 month for free. You can cancel at any time, and there's no questions asked. When people have to leave or they want to leave, you just leave and tell us, and you can cancel. You don't even have to tell us. You can cancel easily. There's no risks. Besides that, you're going to like it. So if you're interested in that, just scan this QR code and check it out. Try it 1 month for free, get all of this stuff, and then if you don't like it, then leave. There is a QR code, and there's a link. I think Alex will include that link into our chat. To get your free trial, select the monthly plan when you go there to the website. All right, now it's time to talk about some questions that I'm seeing. So let's now see. Mikhail says, are there any specific industries or sectors that you anticipate being particularly impacted by QE in the short term? I would say one of the sectors that I'm kind of debating on is the consumer discretionary, because if QE happens, it starts to lower interest rates. And lower interest rates basically gives financing to people to buy the consumer discretionary items like TVs and other things that they need. And so I think that that is one sector that could benefit from it. But there's another problem, though, is if the economy really crashes out, then you're going to want to be in a more defensive sector than that, because consumer discretionary will kind of crash out. All right, Lee says, the QE5 gains momentum. Do you see a bid in U.S. equities as the money printer is turned back on? Yes. That's part of what you see in our strategy is we've increased our weighting in equities. Not so much in U.S., but if U.S. flies, others are going to fly. So yes, I do think that if the Fed pivots, we are going to see a bounce in the market. Now, there is a possibility that the market already anticipates this and that the bounce is not that big and maybe people are still scared. But yes, I would expect that the money printers turn back on, and that would potentially be positive for equity. Also, one of the things to remember is that why are the banks in so much trouble? Why does the Fed have to buy the treasury bonds from the banks? It's because basically interest rates rose so fast, and they have a lot of unrealized losses on the treasury bonds that they own. If the Fed was to reverse and drop its bond rates, its yields, then those bonds that were underwater and had losses are not going to have as big losses anymore. And so, Mikhail, the other sector that could happen if we see quantitative easing with interest rates going down is the bank sector could be one of the best performing sectors, because all of a sudden, all those unrealized losses that have caused people to sell down bank sector would be improved, and therefore that sector could come back up. All right. Ben Mang says, if QE continues, what will happen to stock prices? Yes, stock prices, like I said, will go up. How long will the U.S. be able to print tissue paper and exchange it for commodities? Oh, tissue paper has a good function. I would say that the question is, ultimately, how long can the U.S. print money without causing massive inflation in the U.S. or a devaluation of the US dollar, a significant devaluation? I would say that we're probably somewhere between 3 and 30 years away. The thing is that the government of the US has so much financial and economic power that they can do anything they want. They also have military power. So yes, I do think that in the long run, maybe in the next 3 years, we'll see that the dollar will be falling. But I also think that the government in particular will do anything, getting close to starting World War III, to protect the dollar. Is the Fed free from politics? I would say the Fed is pretty reasonably free from politics. It's not as partisan, Democrat or Republican. Remember that all the Fed members come from the Fed banks, and so they're business people. But I would say it is relatively free from politics compared to the Department of Justice or the FBI in America. All right. So is that why the Japanese are holding off from QT? Well, yeah. If the U.S. reverses, then Japan can just sit there and wait for it. So yes. If the Fed QT attempts fail, inflation will be stickier. Yes, inflation will rise, but it will take time. I think if the economy is weak, then inflation is not going to go out of control. The one thing that can move inflation very hard and very fast is oil price. So if you see oil price reverse, then we've got a problem for U.S. inflation. It can move pretty fast. But because of the owner's equivalent rent is so slow to adjust, then I would say I'm not too worried about inflation. Do you expect inflation to remain high in the medium term? What could be a possible finale to the inflation trap we're seeing? I expect inflation to come down, or let's not call it inflation, let's call it CPI. The Consumer Price Index is an index that the government uses. It's got a lot of flaws in it, but I would say that index was as high as I think 9%. Now it's down to 6%. I think that's going to come down to 4% by the end of the year, and mainly that's because of the issue of the owner's equivalent rent coming down. The price of housing really went up so high, and it takes a lag of maybe 12 months, maybe 18 months for that to feed in. But now we're seeing owner's equivalent rent is getting to a peak, and then U.S. housing prices crashed, and then eventually that's going to feed into owner's equivalent rent. And keep in mind that owner's equivalent rent accounts for 30% of U.S. CPI, so it's not a small amount if it comes down. I think that's the last of the questions. Okay, another one. The oil will not be settled under U.S. dollar anymore. Is it possible? Yeah, I think it is. We're already starting to see it happen, and I think that the Biden administration will go down as the administration that lost America's dominance in the global financial markets, and that they'll be seen as the kind of clowns who just didn't realize that what they were doing was actually terrible for U.S. dominance. Uh, what are your thoughts on the BRIC currencies? Well, I think that that's just natural that we're going to see Brazil, Russia, India, and China all starting to exchange. Whether there is a common currency or whether they're just exchanging each other's currency is a question that I haven't thought too much about it, but I do think, it's possible that they just exchange each other's currencies. BRICS currency is difficult. And one of the reasons why is because each of the countries have different unique value. If you think about Russia, Russia would love to have a currency that is backed by commodities. So if BRICS was backed by commodities, it would be amazing for Russia. But it wouldn't be amazing for India that has no commodities and no oil. So India wouldn't accept a BRICS currency that's backed by oil, as an example. I think that gold is one area that could be what the BRICS currency is backed by. Also, I've also thought that, what is the strength of countries like Thailand, as an example, or maybe China or Brazil, is food. So maybe it ties into the food supply of the country. But I think that the BRICS currency is harder than it seems, so they will probably create something, but getting it to be used is harder than it seems. All right. Wow, that was a lot. And if there's any more questions, just put them in the chat or just turn on your microphone and let me know. And for those people who have any questions, I think we'll follow up. We'll post this on my YouTube channel. And then also we will welcome any of you guys that want to join the Become a Better Investor community. We'll see you there. All right, that's it. Have a good rest of your day. And I enjoyed presenting this latest research on QT. See you guys.
Bye. Thank you.
Bye. Yep.